Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
When I met you in the summer.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of the Equity Mates Summer Series. This is a podcast where we explore what is possible in the world of investing. If you've just joined the community for the very first time, a huge welcome. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. As always, I am very excited for this episode. I am very excited for this series. There are people in the YouTube comments who think that me saying I'm very excited for this episode isn't grammatically correct. I actually think it is grammatically
what's
correct.
Wrong with it?
I don't know. But look, this series has been great. We have been speaking to some of the best financial advisors and fund managers in Australia to really unpack the lessons they've learned over their careers, to understand how they would approach investing if they had to start again today. But most importantly, trying to draw out those actionable insights that we can all apply to our portfolios to make 2025 our best financial years yet. And today we have a big name to help us do that.
We do. Someone who can reflect on decades in the market. It is none other than Geoff Wilson, one of the most recognised names in the funds management business. He has over 44 years with direct investment experience. He actually started Wilson Asset Management back in 1997 and is now the chairman and chief investment officer. He was the pioneer for the listed investment company structure here in Australia.
Okay.
Yeah, I think he started the very first one.
Really?
Yeah, back in the day. So, and I mean, that's clear given the investment opportunities through WAM at the moment. But WAM now invests $5 billion on behalf of 130,000 retail investors.
So this was a pretty fascinating conversation. We obviously unpack his journey starting Wilson Asset Management, what he learnt from that journey. We talk about his investment philosophy today and how the WAM team invest. But I think for me, the most interesting part of this conversation was Geoff Wilson telling me I shouldn't get hit by a bus.
Yes.
No, but what he did was took their investment approach and how they analyze companies and then applied it to how he would analyze and value Equity Mates as an investment.
Fascinating. The valuation we got was crazy. It was a great insight into how he would work through that process with any company. And we certainly took a lot out of it. Yeah.
Now, before we get to the conversation with Geoff, we do want to say a massive thank you to our series sponsor, Viola Private Wealth, who is helping us keep all of our content free and accessible here at Equity Mates. Viola Private Wealth manages over $2.5 billion for high net worth investors with over $1 million to invest. They help individuals and families navigate wealth management from preserving established portfolios to intergenerational transfers and first-time investments. Their tailored solutions make your financial decisions clear, empowering and aligned with your goals.
Trusted by members of the Equity Mates community, Viola Private Wealth helps individuals grow and protect their wealth. So if you'd like to find out more, head to violaprivatewealth.com.au. Now, Ren, without further ado, let's bring him in, Geoff Wilson. Well, Geoff, welcome to Equity Mates.
Hey, good to be here, Bryce and Ren.
Yes.
Thank you, Geoff. We're excited for this one. So,
don't get too excited.
I'm always excited.
We don't want to build up, to me, what is happiness?
What is happiness?
The difference between expectations and reality.
Nice.
So there's going to be will be boring.
Yeah.
It'll be terrible.
Yeah.
And so with a bit of luck at the end, everyone will be really, great.
Really happy.
Geoff was good. He was a lot smarter than I thought. I thought he was dumb.
Geoff, I don't know how you made it into the studio today, but we're disappointed to see you. Let's get through this together.
Thank you.
No, but look, in this conversation, we really want to unpack some lessons that you've learned from your career in investing that we can apply to our investing journeys. You've already given us one lesson, so we're off to a good start. Investing is a lifelong journey. People are constantly learning. The best investors are always working on new stuff. So to kick us off, what are you working on right now?
Well, see, if I tell you that, I'd have to kill you. But yeah, so that's putting the inside information away. Yeah, well, because in theory, the tough thing is when you're an institutional investor, and this is the difficult thing for the retail investor, when you're an institutional investor, you actually get given a lot of information. Now, there's nothing wrong with inside information. You just can't trade on it, because if you trade on it, you go to jail. Well, assuming you get caught. But they're pretty good these days. Yeah. But in terms of like what am I personally working on, and I suppose everyone I work with, I'd say, is the same, is you're all trying to get a little bit better. In terms of investing. I'm a little older than you, but one of us has the same hairstyle. Over my life, it's been a continual evolution, and particularly investing lessons. You're always learning lessons, and I think one of the most important things is being open, to learn those lessons. And the big mistakes that people make is when you go in and invest in the market and you think you know what's going to happen. I remember my early days, I started early 80s in funds management. As a fund manager, I thought, we don't quite know what's going on. It must be the stockbrokers that know what's going on. Then I went and worked as a stockbroker for a period of time, and I realised they don't know what's going on either. I remember years ago, a doctor I was talking to asked me what I did, and I said, I work in the investment game. And he said, so you can never tell me when it's midnight. You can only ever tell me when it's 5 to midnight. Like in theory, we do our research, we find a company, we think it's cheap, and then we think it's a buy, but we're not 100% sure. To me, I thought that was a little bit cheeky. And I said, well, it's interesting. My assessment of your job is you can only ever tell me when it's 5 to midnight as well. Like he can't tell me when I'm going to die or... what is the question? It's continually evolving, and be open. Be very open to learning.
As retail investors, we're not privy to a lot of the information that you get as institutional investors. So how do you keep up with the day-to-day and I guess sort of cut out the noise? What are some of the resources that you use to develop domain expertise that perhaps we can sort of use as well?
What you need to do is, you need to read, you need to listen, and you need to observe, and probably ask questions in there. And to me, you pick up the information everywhere. I drove here this morning, but yesterday I had to catch a taxi somewhere. So whenever I'm in a cab, the first thing I ask the cabbie is how things are going. And he was just saying, things are really tough. And then you try to get a bit of an idea. Like, do you know how much you're taking now compared to a month ago or a year ago? Or and he just said, look, over the last couple of months, just things have got worse and worse and worse. And he said, he's down $100. I didn't end up drilling into exactly how much he was taking on a daily basis, but it's collect information from everywhere. Like look and observe. One of the really good books that I like is the Peter Lynch book, One Up on Wall Street. I remember I was giving blood a number of years ago, and the nurse that was taking the blood asked me a question, hey Geoff, what area do you work in? And I said, I'm in funds management, we invest in the stock market. And she said, I know nothing about the stock market. And I said, who do you work for? And she said, look, my company is, ultimate owner of my company is Sonic Healthcare. And I said, well, what do you think of them as managers? And she said, they're exceptional managers. And I said, well, you know more information about Sonic Healthcare than I do. And Buffett talks about it as well. Focus on your area of expertise. You can collect information from anywhere. You go into Woolworths. You'll have a view of Woolworths, or you might see a brand being sold. Look at the back of the brand. Who makes it? Where is it made? Geez, I think that's going to go well, that company. And it's just all that being aware of what happens in the world, and the economy and collecting information everywhere, because that's where a lot of the value of information you get from. I remember there was a company years ago, it was called So Natural. I think they did rice milk and they did soy milk, and we were shareholders in it. And then you go into the local Woolies or Coles, and then all of a sudden they had the top, they used to be on the top shelf. Then you go in one time and you're on the bottom shelf. And then you think, and then we went and saw the company and said, hey, look, how things are going, and the company said, things are just slowing up a little bit. And to me, when you get those little hints, because they tend to be trends, and that's when it's time to potentially change your mind. So observing, seeing what's being interested in how the world works, and to me, one of the great things is. And you guys do an amazing job, is, hey, when I was growing up, we were sort of focused on going out, having a good time. But the younger generation is more interested in the world, I think, in the world as a place to live in terms of respecting it, but also observing. And, there's a lot, what we've noticed is, in terms of our investor base, there's a lot more younger people that are investing in equities. Maybe it's from crypto, and maybe that's opened the way. But people have realised that the buying shares in a company makes you a part owner of that business. So you benefit if that company goes well, and if it doesn't go well, you don't.
I mean, that's great to hear that you're seeing more young investors come through. I think the negative slant on it is the high cost of housing probably pushes some people into other forms of investment. But I think just like the culture around stock market investing has changed so much. I think, what you've done and what you've built at Wilson Asset Management has been a big part of engaging millions of retail investors over the journey. So you should be credited for that. And we will talk about the Wilson
Thank you, Ren. I'll take that.
But before we talk about...
No, it's not me. It's everyone else in the office that's doing hard work.
You've done your bit. But before
I just make the noise.
Same. That's literally... But before we talk about Wilson Asset Management, I want to go back to your early days when you were going out and having fun, in your words. We want to understand who Geoff Wilson was there and how you thought about finance then. So take us back to the beginning, early days, school, university, starting your career. How did you think about money? Did you have any financial goals back then? And, how were you approaching managing your money to achieve your goals back when you were starting out?
I was fortunate because my father, he was interested in the stock market. And the weird thing is he was interested in the stock market because his dad was interested in the stock market. So I had a slight advantage there. But I had no idea. I remember at the age of sort of, 15, 16, Dad was sitting there. He had I was brought up in Melbourne, so he had a copy of The Age. He had it open, big, broadsheet. And he was looking down at this page, and I didn't know what he was looking at. And I looked at it, and all it was a whole lot of numbers, some names and a whole lot of numbers. And I asked him what that was, and he said, these are all the companies that are listed on the stock market. And you had no idea what the stock market was. Looked down the list of them all, and there was one trading at a cent. Nice. And it was Cox Brothers, and that was back in the 70s, 60s, 70s. It was a retailer, a successful retailer in Melbourne, and it was trading at a cent. And then I thought, geez, I could afford that. And then a little while later, I'd look at it and it was trading at half a cent, and then it went back to a cent. And I was thinking, geez, and I sort of at that age I understood what leverage was. If I bought something at half a cent and it went to a cent, I'd double my money. I didn't pay that much attention, but I remember a few months later going down the list, trying to find the cheapest one again. I went down to the C's, and Cox Brothers wasn't there. It had gone. It wasn't on the list anymore. And I said to Dad, hey, where's Cox Brothers gone? And he said, well, the company's gone under. And it was a retailer, and maybe that's one of the things I've always thought, geez, retailing's tough. Maybe it's because back then, a number of years went past and I probably didn't pay that much attention, and maybe I was sort of around the 17, 18 mark. And Dad, I think we were talking about this in the market, and he said, look, do you want to buy some, I'd like to lend you some money to buy some shares. So I ended up looking down the list, And in those days, it was the late 70s, resources were taking a bit of a run. And the market, it was hard to find any of those 1 centers, but I found this company trading at 10 cents. It was called Timor Oil and Gas. Dad lent me $1,000. I bought $1,000 worth, and my logic was, if it goes from 10 cents to 12 cents, I'm done.
Nice.
I made my 20%, and that's it. And it actually went to 12 cents. I didn't know what they did. Just Timor Oil and Gas. There was no logic behind it except a bit of leverage. And when it got to 12 cents, I thought, look, I'll sell half, and maybe it might go to 13 cents, and for the other half. And then I didn't look for a little while, and subsequently I worked out they were drilling for oil, and they actually went to over 30 cents. I sold my other half at 30 cents. Then it went up, and then it didn't find any oil and went back down. But to me, it's probably like going to the first race, backing a horse, and it wins. Wow, how easy is this game? So that was, I was very naive then. Hey, look, even when I got my first job, which was, I did a science degree, it just happened to be the subjects I found easier. I found it hard to get a job back in the 80s. Unemployment was sort of 15%. But, so about a year after uni, my full-time job that I got was in an investment department at Scottish Amicable. So I sort of, like a lot of males do, bluffed my way in.
Nice.
I know a lot about the stock market. Had done my work on a few stocks and talked about that. My then boss, Chris Walker, sat me down and said, hey, look, Geoff, can you just read these research reports? So for the first couple of days, he just gave me a whole lot of research reports. I didn't know what I was reading. And then after the 2 days, he said, look, hey, Geoff, I just want to understand your knowledge of the market. Do you know what a PE is? And I said, no. And he said, okay. Do you know what EPS is? And I said, no. What's that? And he said, earnings per share. I said, no. So I knew nothing about the stock market, and that's where I started my investment career. Does that answer part of your question?
Yeah, it does. I think it's fascinating, and I think it's reassuring for a lot of people that we all start from zero.
Yeah.
I guess, how did you think about money? Like, did you have a financial goal back then? Was it
to make money?
Just make as much money as possible.
To make money and go out.
Yeah,
that's
right. Make money and spend money.
Exactly. That was my financial goal.
Nice.
Take us to the point then when you started Wilson, because that obviously
Wilson Asset Management.
Obviously had a slightly, I guess, a bit more of a refined goal from your period of stockbroking and then starting Wilson. What was the goal there?
Starting Wilson Asset Management was, I had a little bit of money back then. The opportunity presented itself. It was for me to put my little bit of money with other people's money and be seen as a institution. When I was an analyst, you have incredible access to managing directors of companies. You're in your early 20s and you're seeing the guy who's running BHP, hypothetically, or National Australia Bank, or you get incredible access. So to me, the logic was put my money with other people's money, and like to make a difference for myself in terms of getting that access and getting a great return, and to make a difference for the other people that we managed money for. And then as the business has evolved, and it sort of, we've moved up the Maslow's hierarchy of needs, like in theory, the early days, when I started Wilson Asset Management, I put 100% of the money I had, which was $500,000, into the fund. Reg Grundy, Tim Hughes, who was the CEO of Reg Grundy, he said he'd give me $10 million to manage. On day one, he said, how much are you putting in? I said, everything I've got, $500,000. He said, I'll match you with $500,000. So we started with $1 million, even though they put more over time. But so it was, to me in the early days, it was to make a difference in terms of perform. But as the business got bigger, and then we can make a difference actually for the community we operate in. Whether it's the investors, stand up for investors that have supported us. The business wouldn't exist if we didn't have the shareholders that have supported us. So, to me, that's been the focus. To make a difference in financially, but also from a community perspective.
And you've been successful managing over $5 billion now and 130,000 retail investors in the funds. Where are you on the hierarchy at the moment, Maslow's hierarchy, and what's the goal from here? Where does Wilson go?
Our 60-odd employees, we're all at different levels.
Yes.
On the hierarchy, particularly the newer ones, they're probably, we're all at different levels. Yeah, it is an organisation, so we've got to all go together. They say about companies, if you're not growing, you're going backwards. That's over time. You need to grow. You don't necessarily need to grow every year, but over time. But in terms of what sort of our objectives or what we'd like to do, again, probably go back to the core value is to make a difference and continue to make a difference for all the investors that invest with us financially. We've been fortunate enough to set up 2 pools of capital, which are future generation companies. And we've got other fund managers to manage the money for free. So therefore, money goes to support youth mental health and children at risk. And like this year, we'll have effectively given $85 million to those areas in Australia, which is great. We've got more work to do on that. The government talks about getting Australians to give double the amount of money to charity between now and 2032. We put a proposal in to the government, a really innovative way of doing that, which I don't think they're going to pay that much attention to.
What was the proposal?
It was just to see, effectively, the incredible thing about the future generation entities is that $85 billion that's gone to help youth mental health and children at risk in Australia, that's occurred because the fund managers that normally charge fees are doing it for free, and everyone else involved, like the ASX doesn't charge us listing fees. All the service providers are doing it pro bono, and the normal fees for those service providers would be $140 to $150 million a year. So the investor's actually getting a cracking deal. He's getting exposure. He's only paying $85 million. He's getting $150 million of value. So the investor's getting a great deal. The fund managers or the people in the finance industry, they're doing it pro bono. And the great thing about funds management, it's a scalable business. So we manage $5.5 billion, which we get paid for. We can manage another $1 billion for free. So to me, it's a really scalable model. And what we were suggesting, that the government, these vehicles, makes them a bit more attractive. I remember years ago, the government created these vehicles that tried to encourage companies to invest in smaller companies. They were called pooled development funds. And if you put your money into those companies, then it would be any capital gain you made was tax-free.
Oh, wow.
Oh, wow. Okay.
Yeah. So they still exist.
Oh, really?
Yeah. We've got one.
Oh,
it's
right.
unlisted, but
you
to
want
me,
to invest in a fast-growing media business?
Let's talk. We'll list it one day, maybe. So to me, it was to encourage investing in smaller businesses. Very innovative. So to me, it was a very simple thing. And then, if that was the case, if they did that, then there's about $3 billion in that space in Australia. We've got about $1.1 billion of it. Other people have followed, and we've have done similar things. But that could be $100 billion. So then all of a sudden, $1 billion a year is going to charity. To me, if you want to change the dial, you've got to make some big decisions, but they're obviously not prepared to do it at this point.
Yeah. Well, rumours are a lot of federal politicians listen to Equity Mates, so maybe this will be...
Hey, that's great. That's great. I know. Well, they'd be smart if they did. Yeah.
Now, Geoff, we're going to have to quickly pause the conversation here so we can thank our series sponsor, Viola Private Wealth. Managing wealth of any size can be intricate, but Viola Private Wealth is here to guide you. By creating bespoke strategies and aligning investments with your unique goals, they ensure every financial decision feels confident, clear, and sustainable.
Love that. For more information, head to violaprivatewealth.com.au. So I guess, Geoff, from that that first fund that you started, you now have, including the Future Gen LICs, you've got 10 listed investment companies. And what we'd love to understand, rather than going through each of them, is across those 10 LICs, have you developed and has the team at Wilson developed like an investment philosophy that goes across all of them?
Yeah, we'll go through that. And because we're talking about listed investment companies and investing, and investing lessons. To me, if you don't know anything about the market, as Warren Buffett says, hey, buy an index fund or an ETF. So to me, listed investment companies are the next level up. If you know a little bit about the market, then look at listed investment companies because you've got to do a bit more research. I coined the phrase, the listed investment company, it's the thinking man's ETF. Or the thinking person's ETF is the listed investment company. Because you've got to do a little bit of research. Over my sort of investment life, what's the best way I've found to invest money? That's the principles we use. Like the greatest correlation between the stock market and anything that I've found is earnings per share. So earnings growth of the company, earnings per share growth of the company. And there might be times where earnings go up and the share price doesn't do anything, but over time, the greatest correlation is that. Also, what's incredibly important is management. So just like, say if Equity Mates was a listed company, then people would make an assessment of what's Bryce and Ren like. Do we want to back them? Because the CEO of the company, that's what everyone, when they buy shares in a company, they become a part owner of that business, and they've got to make an assessment of the guy who's running it. Do I want to back him? So management is very important to us. So earnings growth, it's management. We've got a little matrix. It's a rating, a way of rating companies. So we rate management out of 10 and then multiply it by 2. You'd say, why don't you just rate them out of 20? Well, you don't, because in theory, if you rate someone out of 20, you'll give them a different number than if you rate them out of 10 and multiply by 2.
Yeah.
We look at the earnings per share growth, and it's really hard to predict earnings per share growth, but you have to try to do that, and we do it the next 2 years' earnings per share growth. Because predicting any further out than that, it's nearly impossible. There are too many variables. So we look at the next 2 years' earnings per share growth. Then we look at, there's got to be a valuation metric, and that's price earnings ratio. But what we do is we do earnings per share growth divided by PE to get a GARP sort of, a relative value thing. And then we multiply that by 10 to get it relative. Because in theory, Equity Mates. I'm assessing Equity Mates.
All right, here we go.
And the last one is the industry they operate in and where they're positioned in that industry. That's the last one. And then once you do all that, and once you think it's cheap, then you don't buy it unless you can find a catalyst that's going to change the valuation.
Yeah.
Because you're better off we believe you're better off sitting with your money in cash until you can find something that's going to change the value of the company, because Equity Mates might be cheap forever. Like hypothetically, the company might be cheap forever.
Yeah.
Okay, so we'll rate you guys. Okay, so we rate you out of
20.
So out of 10, what are we? Oh well, actually, I think you guys are pretty good. I'm a hard marker.
Okay,
but actually, I don't know how you manage people, but I think you're good guys. So I'll give you 8 out of 10.
Nice.
So, but see, like if I'd rated you out of 20, I might have given you 18 out of 20. But see, so you got 8 out of 10, so you had to got 16.
Yeah.
Okay, so earnings growth. Well, you're gonna have to show me how much you're earning. I don't know.
It's great.
But anyway, great. Okay. So why don't we say your earnings have grown 20%. No, I know it's a lot more than that, but let's just because you're a listed company. 20%, and we look at it over the next 2 years. So 20% this year, but then. I don't know. I've got to understand how you make money. So, and this is what everyone else has to do. When you're trying to assess how a company makes its money, it's quite simple. How a company makes its money. It's the difference between revenue and costs. So I would say, being in here, your costs are very low.
Yes.
That's
my assessment.
That's fair. We're on a lean operation.
Yeah. That's right. So costs and the change for costs. So obviously rent.
Yeah.
So I got to make an assessment of rent.
Yeah.
And then on the revenue side, I assume, do you make your money in advertising?
Yep.
Yeah.
Yeah.
The bulk of it,
Okay. And you're growing at quite a rate. So I'd
knots.
assume, rate of knots. So I assume I'd assume you'd be growing pretty strongly. So to me, that's what you're doing with a company. Any Woolworths, you've got to make all these companies. You should be making all those decisions when you decide to buy shares in Woolworths. So we're giving you 20%. So then, in the back of our mind, and I'm just making this up for a podcast. It's only a bit more realistic. I think there's going to be, even though you guys are going exceptionally well. Let's assume interest rates were going to go up higher. They're not. But let's assume they're going to go higher. And then I think through my mind, their revenue's probably going to drop. It's not going to grow at the same rate. Or they're quite mature now. Yeah, because I've got to make an assessment for next year's. So 20% this year, 10 next year. Yeah, and it's a bit extreme, but
no, that's fine. There's always younger and hungrier podcasters coming through.
I think you'll do whatever you do this year. You won't grow at the same rate, but you'll grow well next year. But anyway, so that's the average of that is 15.
Yeah.
So what do we got? We got 16 and 15. They're the first two numbers, and then we look at earnings growth. So we've got the 15, and we divide that by the PE you are.
Okay.
But so then I've got that's the value of the company minus the earnings. Let's just say let's say you're making $1 million, which you're not, I know. And let's say you valued at $10 million.
Yeah.
Yeah, so then you're on a PE of 10.
Yeah.
Okay, so the third one we do is the 15, which is the average EPS growth for the next 2 years, and divide it by the 10. So that's 1.5. See, that's why we multiply it by 10. Okay. Because if you're growing at double your earnings, then it's 2.0.
Yeah.
And if we left it at 1.5, then you're looking at 1.5 relative to the 15% earnings growth. So your valuation number you're using is a tenth.
Yeah.
So we're trying to get it relative. So okay. So what have we got? We got what are you at? You're 30. You're at 46. Okay. And the last thing, this is your numbers in terms of we've added them up.
Okay.
And the last one is industry position.
Leading.
Well, it's industry position and industry you're operating.
Yeah, that's the thing.
We merged
Media,
them both into
tough.
one.
Yeah. Media and finance, media business, pretty strong.
No. But I think you're doing really well. So I'd actually probably give you 8
out of
100.
10. Out of 10.
Nice.
Yeah. But we add the 8 to the 46. That's 54.
Okay.
You just rate.
Oh. Yeah.
Do you want to cut us a check?
No. If you're 50,
is 50 your base?
50. Yeah. So you rate. So you could be a buyer now.
Nice.
But we're not going to buy you. No, we're not until we can see a catalyst going to change the valuation.
Yeah.
Regulation changes.
So one catalyst that could change the valuation. If when Ren walks out the door, gets hit by a car.
Yeah, I mean, Bryce will be free.
That'll be a sell.
Yeah.
That's a negative catalyst. Or when we find Ren's alter ego, Alex, isn't it?
That's it. Yeah.
No, but what could be a catalyst? What could be a good catalyst?
Well, I think one that's playing out at the moment is regulation change in financial advice, for example. Like, will it become easier for us to deliver more advice at scale?
Oh, geez.
Yeah, and so then what we're doing becomes more than just...
Oh, so your business model changes.
Yeah.
Oh, wow.
Yeah.
That could be a very positive
Massive.
catalyst.
Yeah.
Well, that would be massive because you've got a great franchise, great business. And then...
could we plug a funds media business?
Funds management. Bloody hell.
Would we be the top of the funnel for the next Geoff Wilson company?
Geez, that'd be a big catalyst.
Yeah.
Everyone
Now
want to
we're
buy
talking.
equity mates there. Well, see, but that's what you got to work out.
Yeah.
Like, to me, that's. So we're trying to buy undervalued growth companies and buy them when we can see a catalyst going to change the valuation.
Yeah, nice.
Anyway.
I like that. I think that's a really actionable way for anyone who's listening to then apply that to their own stock.
But then if you want to go, that's sort of that's the people, as we talked about, ETFs are the sort of the people that have got no idea. Listed investment companies are the thinking person's ETFs. And then we went to the extreme one, where if you want to buy shares in a company, sort of the process that if you want to try to maximise your investment, what you should go to. But in terms of you take one step back, with ETFs you get in at the value of the index or whatever you're getting exposure to, and you get out at. The beautiful thing about listed investment companies, and to me this is nearly the holy grail, is the assets are what it's worth, and that's what you sort of get into on an ETF and out at. But a listed investment company, the share price can be something different. The assets might be worth $1. They call it NTA, but the share price might be trading at $1.10 or $1.20. But also, the share price of $1 might be trading at 70 cents or 80 cents. And to me, if you can buy $1 of assets at 80 cents, then why not do it?
I was going to say, a lot of Aussie LICs are trading at the discount. I think that's where you deserve a lot of credit, that you've managed to keep at NTA or above NTA for most of
half
Wilson's
of our,
journey.
of the Wilson Asset Management, the 8, 4 of them are trading at premiums. One a couple of years ago was trading at a 58% premium. Like the 58% premium is as ridiculous as the 30 or 40% discount. And then the other 4, another one's trading around NTA, then 3 of them are trading at discounts, and they tend to be our newer LICs because it just takes time for the share registers to tighten up for everyone who understands what you're doing to align reality and expectations, because a lot of times people invest in something and they're expecting say the share price to go up 50% in the next year, and hey, unless the market does that, then it's not going to do it. So to me, it's just once you tighten your share register up, then it's the marginal buyer and seller that dictates the share price.
Geoff, if you had $1 million to invest today, outside of your own funds?
Well, no. Well, it sounds like I'll be buying shares in equity, mates. You've just primed me for that. I think, is that me misleading and deceptive conduct?
This is all a giant pitch.
Why do we stop this and maybe we start again? Sorry, $1 million to invest, yes.
Yeah, if you had $1 million to invest today, of all the experts that we're going to be getting on in this series, how would you think about approaching that? Where would you be putting it, like either specifically or from a principles-based, without, I guess, your own funds?
And like all this, caveats, we can't give advice. And when you ask me that question, I think, well, you guys are young in a relative sense. To me, you've got to take in a lot of considerations. And probably if I just sort of group it into young people and old people, and I mean, what I would do, and like as I sort of, if you know nothing about the market in ETFs, and then if you really want to do a lot of work on the market, and to me it's a great hobby, it's incredible. It teaches you a lot about yourself, it teaches you a lot about your emotions. One thing, it's not great relationships, the market isn't, because in theory when you invest in the market you have to have an ability to turn down your emotions, and in life you've got to turn up your emotions. I've probably spent the last 20 or 30 years trying to turn up my emotions. You've got to work against your emotions when you're investing. So put all that to one side. If I want someone else to do that for me, then what I would do is I'd buy listed investment companies, and I know there are a lot of them that are trading at discounts to NTA, and you've got some of the larger ones, the AFICs and the Argos, which normally trade around the value of the assets, NTA, they're trading at quite sizable discounts. So at some point in time, if you're taking a medium long term, they'll go back to NTA. So if I was younger, I would have a bigger skew to global listed investment companies, because you're getting exposure to the market and you're getting it cheaply. And if I was older, I'd have more exposure to Australian listed investment companies. And the logic behind that is, if you're younger, you probably want to make capital gain because you only pay half your tax rate on capital gain in Australia. And if you're older, your tax rate's probably lower. You might be in your super. You might have your money in your self-managed super, and you want the franking credits. So to me, that's the skew of the different one.
Nice.
And if you're younger too, in terms of investing in globally, over time, we know the market will deliver to you over time. So you can take a long-term view.
So, Geoff, to close this conversation, we've got two questions where we really want to just give you a chance to share some of the biggest pieces of wisdom you have with our audience. And
first of all, that's a big. That's an assumption.
Oh no, I think it's a pretty safe assumption. I think it's So I think if there was one piece of investing knowledge that you wish every young investor knew, what would it be?
People talk about. One thing I'm not keen on is like in the investment game, everyone's they've all got their little phrases, how do you invest? Oh, what we do is we fish where the fish are, or say it's a tough market. Yeah, and they say it's darkest just before dawn. I mean, I only see dawn when I get up to go cycling. You guys will see dawn when you come home. But you never know. Like at the bottom of the market, you don't know it's the darkest before dawn. You only know it in theory, you want to buy when it's darkest, when the market's worst, but you don't know until the market's gone up 20%.
Yeah.
From a work perspective, everyone can make a difference. In life, everyone can make a difference, and investing, everyone can be a very successful investor. Don't leave it to the professionals. I remember Robert Maple Brown, who very successful fund managers, passed away a number of years ago. Before, maybe in our younger days, Matthew Kidman and I might have had a podcast, but we ended up writing a book called Masters of the Market. And I remember when we were interviewing him, he was telling us about when he started in funds management. I think it was the 70s. And he went home and told his parents, I've got a job in funds management. They said, what? Someone is going to pay you to manage their money? Because in those days, everyone just managed their own money.
Yeah.
And they said, we cannot believe that. You're going to get paid. So, everyone has the skill.
Yeah.
The question is, whether you're prepared to give the time. So, to me, everyone can be as good as you as an investor, as yourself, or as myself. They can, spend the time, and you can.
Well, I think that's a great place to leave it. Everyone can be a successful investor. Geoff, you've certainly been successful in your career, and we thank you so much for coming on and sharing all your words of wisdom with us and the Equity Mates audience. It's been fantastic. Thank you so much.
Thanks, guys.
Thanks. Geoff. All right, well, before we go, we want to say a massive thank you again to Viola Private Wealth, who turns complexity into clarity. With a highly personalised approach and proven track record, they simplify wealth management so you can focus on what matters most to you. For more information, head to violaprivatewealth.com.au.
Stick around because next episode we are welcoming back a guest who has appeared on the show a number of times before, and that is Elise Kennedy from Schroders. She's an investment analyst, often comes with a bunch of stock tips in Australian tech, and we're really excited because she's been working on a number of sectors that I know are going to be of interest to the Equity Mates community. So make sure you subscribe wherever you're listening, and we'll see you next episode.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.